Welcome to Thoughts on the Market. I'm Michael Zezas, Global Head of Fixed Income Research and Public Policy Strategy.
And I'm Michael Gapen, Chief U.S. Economist.
Today, how are tariffs impacting the economy and what it means for bond markets? It's Wednesday, August 13th at 10:30 a.m. in New York. Michael, we've been talking about how the near-term uncertainty around tariff levels has come down. Tariff deals are, of course, still pending with some major U.S. trading partners like China, but agreements are starting to come together. And though there's lots of ways they could break over time, in the near term, deals like the one with Europe signal that the U.S. might be happy for several months with what's been arranged. And so the range of outcomes has shrunk. The U.S.'s current effective tariff rate of 16% is about where we thought we'd be at year end, but that's substantially higher than the roughly 3% we started the year with. So not as bad as it looked like it could have been after tariffs were announced on April 2nd, but still substantially higher. Now's the time when investors should stay away from chasing tariff headlines and guessing what the president might do next, and instead focus on assessing the impact of what's been done. With that as the backdrop, we got some relevant data yesterday, the Consumer Price Index for July. You were expecting that this would show some clear signs of tariffs pushing prices higher. Why was that?
Well, we did analysis on the 2018-2019 tariff episode. So in looking at the input-output tables, which give you an idea of how prices move through certain sectors of the economy, and applying that to the 2018 episode of tariffs, we got the result that you should see some tariff inflation in June, and then sequentially more as we move into the late summer and the early fall. So the short answer, Mike, is a model-based plus history-based exercise that said, yes, we should start seeing the effects of tariffs on those categories where the direct effect is high. So that'd be most of your goods categories. Over time, as we move into later this year or early next year, it'll be more important to think about indirect effects, if any.
Got it. So the July CPI data that came out yesterday, then, did it corroborate this view?
Yes and no. So I'm an economist, so I have to do a two-handed view on this. So yes.
Always fair.
Always, yes. So yes, core goods prices rose by 0.2 on the month. In June, they also rose by 0.2. Prior to this, goods prices were largely flat, with some of the big durables items like autos being negative, right? So we had all the give back following COVID. So the prior trend was flat to negative. The last 2 months, they've shown 0.2 increases. And we've seen upward pressure on things like household furnishings, apparel. We saw a strong used car print this month, motor vehicle and repairs. So all of that suggests that tariffs are starting to flow through. Now, we didn't, on the other hand, we didn't get as much as we thought. New car prices were flat, and maybe that those price increases will be delayed until models, the 2026 models, start hitting the lot. That would be September or later. And we didn't actually, I said apparel. Apparel was up stronger last month. It really wasn't up all that much this month. So the CPI data for July corroborated the view that the inflation pass-through is happening. Where I think it didn't answer the question is, how much of it are we going to get, and should we expect a lot of it to be front-loaded, or is this going to be a longer process?
Got it. And then does that mean that tariffs aren't having the sort of aggregate impact on the economy that many thought they would, or is maybe the composition of that impact different? So, or maybe prices aren't going up so much, but companies are managing those costs in other ways. How would you break that down?
We would say, and our view is that, yes, we have written down a forecast, and we used our modeling in the 2018-2019 episode to tell us what's a reasonable forecast for how quickly and to what degree these tariffs should show up in inflation. But obviously, this has been a substantial move in tariffs. They didn't start all at once. They've come in different phases, and there's a lot of lags here. So I just think there's a wide range of potential outcomes here. So I wouldn't conclude that tariffs are not having the effect we thought they would. I think it's way too early and would be incorrect to conclude, just because we've had relatively modest tariff pressures in June and July inflation, that we can be sanguine and say it's not a big deal and we should just move on.
And even so, is it fair to say that there's still plenty of evidence that this is weighing on growth in the way you anticipated?
I think so. I mean, it's clear the economy is moderated. If we kind of strip out the volatility in trade and inventories, final sales to domestic purchasers was 1.5 in the first quarter, it was 1.1 in the second quarter. And a lot of that slowdown was related to spending by the consumer and a slowdown in business spending. So that could be a little more maybe about policy uncertainty and not knowing exactly what to do and how to plan. But it also, we think, is reflected in a slowdown in the pace of hiring. So I would say you got the policy uncertainty shock first. That also came through the effect of the April 2nd Liberation Day tariffs, which probably caused a freeze in hiring and spending activity for a bit. And now I would say we're moving into the part of the world where the actual increase in tariffs are going to happen. So we'll know whether or not firms can pass these prices along or not. If they can't, we'll probably get a weaker labor market. If they can, we'll continue to see it in inflation. But Mike, let me ask you a question now. You've had all the fun. Let me turn the table.
Fair enough.
How much does it matter for you or your team whether or not these tariffs are pushing prices higher and or delaying cuts from the Fed? How do you think about that on your side?
Yeah, so this question of composition and lags is really interesting. I think, though, that if the end state here is as you forecast, that we'll end up with weaker growth. And as a consequence, the Fed will embark on a substantial rate cutting program. Then the direction of travel for bond yields from here is still lower. So if that's the case, then obviously this would be a favorable backdrop for owners of U.S. Treasury bonds. It's probably also good news for owners of corporate credit, but the story's a bit trickier here. If yields move lower on weaker growth, but we ultimately avoid a recession, this might be the sweet spot for corporate credit. You've got fundamental strength holding that limits credit risk, and so you get performance from all-in yields declining, both the yield expressed by the risk-free rate as well as the credit spread. But if we tipped into recession, then naturally we'd expect there to be a repricing of all risk in the market. You'd expect there to be some expression of fundamental weakness, and credit spreads would widen. So government bonds would have been a better product to own in that environment. But of course, Michael, we have to consider alternative outcomes where yields go higher, and this would turn into a bad environment for bond returns. That would appear to be most likely in the scenario where U.S. growth actually ticks higher, resetting expectations for monetary policy in a more hawkish direction. So what do you think investors should watch for that would lead to that outcome? Is it something like an AI productivity boom, or maybe something else that's not on our radar?
Yeah, so I think that is something investors do have to think about. And let me frame one way to think about that, where ex post any easing by the Fed as early as September might be retroactively viewed as a policy mistake, right? So we can say, yes, tariffs should slow down growth, and maybe that happens in the second half of this year. The Fed maybe eases rates as a preemptive measure or risk management approach to avoid too much weakness in the labor market. So even though the Fed is seeing firming inflation now, which it is, it could ease in September, maybe again in December, because it's worried about the labor market. So maybe that's what dominates 2025, and like you said, perhaps in the very near term, continues to pull bond prices lower. But what if we get into 2026 and the tariff effect or the tariff drag on growth fades and the consumer begins to accelerate, so we don't have a recession, we just get a bit of a divot in growth, and then the economy recovers? Then fiscal policy kicks in, right? We don't think the One Big Beautiful Bill Act will provide a lot of stimulus, but we could be wrong. It could kickstart animal spirits and bring forward a lot of business spending. And then maybe AI, as you said, that could be a combining factor. And financial conditions would be very easy in that world, in part, given that the Fed has eased, right? So that could be a world where, growth is modest, but it's firming. Inflation that's moved up to about 3% or maybe a little bit higher later this year kind of stays there. And then retroactively, the problem is the Fed eased financial conditions into that. And and inflation's kind of stuck around 3%. Bond yields, at least the long end, would probably react negatively in that world.
Yeah, that makes perfect sense to us. Well, Michael, thanks for taking the time to talk with me.
Thanks for having me on, Mike.
And to our audience, thanks for listening. If you enjoy Thoughts on the Market, please leave us a review and tell your friends about the podcast. We want everyone to listen.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.